So we do expect, as Julian highlighted as well, that with the current account deficit creating less pressure on that front, that the U.S. dollar will begin to creep up. Maybe sometime in the first quarter, second quarter of next year, perhaps ahead of the expectation that the Fed will start to raise rates. On the whole, just what that means, obviously there's going to be an upside for commodity prices for as long as the U.S. dollar is deemed to be weakening. I think that plays into the inflation expectations partly as well. Fundamentally, we don't, that's where I think there is going to be near-term opportunities for what we call material stocks, which is essentially commodities, and also for the energy, which is on the oil and gas side. Gold has been going up. We still expect gold to continue to rise, but we wouldn't chase it at these levels. We think there are better upside in some of the other precious metals, for example. Obviously, we think fundamentally oil price itself has reached an equilibrium level between $65 to $75. We really don't expect it to just be sustained above the current levels over the next year or so, which is one of the reasons why we think inflation is actually fairly benign over the next 12 months.
The central bank, this central bank policy, and that we remain very much...
Actually, not really,
Okay.
Other than ringgit, which has appreciated against the dollar, it's basically dollar weakness, not ringgit strength.
Yes.
If you notice, the yuan has been going down at the same rate as the dollar over the past month or so. And I think the Chinese are basically trying to make sure that the yuan doesn't, over appreciate against the dollar and gets more pressure from the US, in terms of trade barriers and, pressure in terms of weakening the Chinese currency. So in that sense, I think the ringgit has turned out not that well, but pretty well. All right. But again, is a function of the regional economies in terms of where is the economy headed, as well as interest rates. All right. I think the panelists have rightly pointed out that interest rates will likely remain where they are for a time being. So on that basis, except for Australia, which recently raised and allowed the Aussie dollar to really, Aussie dollar is nearing this all-time high, and that is actually putting pressure on a lot of other currencies. But generally speaking, with the dollar weakness, it is obvious regional currencies will continue to appreciate, ringgit being no different. And I think even against the Sing dollar, actually, we have appreciated back a bit over the past couple of weeks, actually. So I beg to differ that the ringgit, has not performed.
Do you think there will be a situation whereby China moves down and then the entire Asian bloc, we can go back to 250 to the US dollar and we'll all be rich and we can go and buy things, and that's part of the rebalancing, you think? You think that can happen?
Well, I always believe that you can't really compare ringgit with just the dollar exchange rate. I think you got to look at cross-currency rates. You got to look at where is ringgit against the Sing, where is ringgit against the Aussie, where is ringgit against the yen or pound. Don't just look at ringgit dollar. Dollar can be weak and we can be artificially strong because of dollar weakness.
Well, I was thinking more like, the whole of Asia remains very export-oriented. We are scared to let the ringgit appreciate, or the whole of Asia is afraid to let their currencies appreciate if the yuan doesn't move. But if
don't
the yuan
forget,
moves,
I think Malaysia, after depegging, Malaysia has basically maintained a trade-weighted ringgit in the market. So in that sense, the ringgit's movement will basically reflect, the movement of the region in terms of, where our trade is.
I see.
All right. So on that basis, I think, the Asian currencies will, with the exception of the yuan, all right, with the Asian currencies will likely move in tandem.
I see. Okay. Really, I was told we don't have that much time, so we are not going to open it to the floor. I apologize. I have one last question for all the panelists, actually, really to round up. What keeps you all awake? What issues out there keep you awake at night? Meaning, you're and it's not the personal issues, it's the market issues. What keeps you awake and starting with you, Pankaj, since you have the microphone.
I can't help it, but I have to watch CNBC every night.
That keeps you awake at night.
Yeah, it keeps me awake, at least for an hour. But I think being, very much close to the market and managing a large fund size, I think we have no choice. Although, some of us as fund managers, we may be investing just in Malaysia, but, what happens in Malaysia, it basically has being influenced by what's happened around the world. So you can't run away from watching the US market, watching where currencies are going, where interest rates are going, what the Fed is saying, how is US consumer confidence. So all that will come into play. And that is why, I'm not sure about Lauren and Julian, but, I watch my CNBCs every night. So.
But what worries you? What worries you?
Worries me when the US market were to tank by 500 points or more. Yeah.
Well, okay.
I was going to say the problem for most, I know for speaking for our analysts, the problem, the nightmare they had was a lot of their sell calls actually did very well this past few months. So, that was the thing with a market that's moving up, which actually is a very nice thing to sleep to is when it moves up for most of us. I think for me, I'm more worried about the politics of what's going on in the U.S. because there's a lot of political pressure exuded on the expenditure side, and obviously there's pressure to try and repay the money that is being spent. And I think it gets easy for things to go overboard either way and send us back down into a precipice. So it is a situation where you're talking about trade, too much on the trade protectionist side, for example. Some of the expenditure side that the U.S. government is arguing over at the moment, healthcare, etc. They're going to have to raise taxes one way or another. Where is that coming from? Will it come from the corporate side as far as the trying to tax the overseas income, for example? I think those are very negative connotations underlying for the U.S. market, and therefore that tends to worry me. The pain is on the U.S. side, so I would still worry about what they're up to politically.
Sorry, can I just ask you? Do you think we can decouple? I mean, that's a U.S.-centric problem.
No.
Asia we go our own way. Can we decouple from them if they?
There's unfortunately no one spends as much as they do, the U.S. consumers. So we're still beholden and hopeful that they continue to spend and buy the products from Asia.
Okay, Julian. What keeps you awake at night besides?
Okay, as for me, I watch Bloomberg instead of CNBC. But because CNBC is very noisy, each time when I turn to the channel, you see traders screaming here, screaming there. Oh goodness, after a hard day in the office, that's the last thing I want.
That's American television for you, okay?
Oh, right, okay. Pankaj, he reads Bloomberg in the daytime. Okay, so as for me, I guess two things that I look out for in the reports that I read or in the Bloomberg television I watch at night: terrorism and bankruptcies. Okay, the world is not as safe as before.
Are they related? Sorry. All right.
I hope.
Please, go on.
I hope not. First one, bankruptcies. I don't think that we are out of the woods yet. The reason why banks are announcing positive results now is because of the huge, massive liquidity that is being injected in the system. Okay, we are seeing CIT on the verge of being bankrupt. But of course, the Fed and the US government came in. But that's in the US. We never know what's going to happen in the Euro region. Knowing that some of these banks may not be marking to market their books at all, especially the derivatives front. Okay, and the key is that these things will happen at the point where you least expect, in a market where you least expect as well. The point in terrorism is that it can happen anytime, anywhere. The worst you can have is that global growth or global recovery remains fragile, and at the same time you do see another September 11th kind of crisis. Okay, the world economy and the world market cannot sustain that, and especially now because of the huge liquidity that has been being induced by all these central banks around the world that cause funds to flow into emerging markets. Once you have this kind of terrorism and once you have this kind of heightened risk aversion scenario, funds will be pulled out massively from emerging markets, and you see a collapse in these kind of markets, and you see a collapse in these currencies as well. So this is one of the risk factors that we hope will never happen. Thank you.
Thank you. Interesting. No one has mentioned H1N1 meets bird flu, which remains a potential
Overweight
risk.
healthcare.
Sorry?
That's why we overweight healthcare.
Overweight healthcare and rubber gloves. That's what's driving growth. Thank you very much. I think in summary, really, these markets are very much liquidity driven. Okay, that's a sign for me to end. Thank you. I'd like to thank the panelists. Can you give them a big round of applause? I hope you're all wiser after this, and I'll pass this back to the MC. Thank you.